Today I want to compare renting versus owning. What are you actually spending over the course of 10 years and what are you actually gaining over that course of 10 years? And I want to show you how buying real estate can actually be a really big win, even if you have to co-own in order to get approved at first. A lot of people can't get approved on their own and they don't really realize that if you have somebody that you trust and can co-own with, or maybe I can connect you with and you get along and you feel you work well, co-ownership actually does work when you want to build wealth in real estate. And I don't want to go too far into that. My main focus today is to give you a theoretical example of how building wealth in real estate works, and to kind of get you thinking like, hey, I got to start thinking for my future. I want to be able to retire. And a lot of people my age, I'm 28, a lot of people under 30, under 40 even, aren't really as focused on their retirement as they should be. It's going to be one of the, I call it the financial curse of my generation, is everything's so expensive that nobody can really save. Well, let's face it, if you replace a rental payment with a mortgage payment, you are saving in a way. And that's what I'm going to show you today. So let's dive in. I have to add a little compliance disclaimer in here. This is not intended as financial or legal advice. This is an estimated theoretical example based on current trends continuing. These are current long-term trends. They're not just trends from the past year or where we've had a correction year. Like at the end of the day, I don't know you. And if I don't know you, I can't help you. And there's going to be people watching this video who I don't know at the end of the day. So I have to put a disclaimer in there just to make sure. But the other thing too is everybody's situation is different. I do want to put in here, I'm not trying to predict the future. I'm just trying to show you possibilities. So let's dive in. So first up is the rent payment. I'm going to assume that the rent payment to rent an entire house without having to share it with people on the upper or lower level, what have you, is going to be about $3,000 a month. That's just a personal observation. I'm not going to cite it or anything. Rents often start at around the $1,500 mark if you want to get an entire floor, but also get something that's livable. And if you want something that's nice, you're usually hitting that over 2,000 mark, in between 2,000 and 2,500. Again, personal observation. I'm not going to cite anything there. Let's say $3,000 a month to get the entire house over 10 years. So basically, year over year, you're paying about $36,000 a year. At the end of the 10-year period, so if we're starting in 2026, we end in 2036, you end up spending about $396,000 over the course of that 10 years. And the key to remember is you're not getting that money back. Now, am I against renting? No. If renting works for you, great. It's just something to be aware of is where's your money going? Now, is there an alternative to this? Yes, there is. There's home ownership. Now, this is a graph I want to show you, and this shows the benchmark prices for Niagara. It's been seasonally adjusted, so I'm going to explain what some of this means. So the benchmark prices, they're an adjusted average. They take out the outliers. So if you have a $2 million house in a $500,000 neighborhood, it will get rid of that so that way your average isn't skewing upwards. Now, seasonally adjusted is just about getting rid of those spring highs and the winter drops that we see in pricing. So this is probably, in my opinion, the best way to look at long-term trends. So I put this in Excel, I graphed it. One little caveat here is I didn't want to end in December. I wanted each month to show January 1st. And the reason I wanted this was I wanted to show the start of the year rather than the end of the year. Because let's face it, we are in the start of the year right now. It's January 2026. Benchmark numbers aren't out yet because January 2026 isn't over. So what I did is I looked at the change in December. It was a drop of about 7.5%. And I just sort of adjusted January from there. So the only number I actually played around with here is January 2026. The other thing is I added a trend line, and I'm gonna get more into that later on. You are gonna see this again. But basically, what I did is use this to assume that a price for January 2026 would be $587,375. Now, you could get a house that's cheaper than this, you could get a house that's more expensive than this. That's not what I'm going into here. I just want to focus on a theoretical example. Now, Here's what happens when we buy a house at this price. So I'm going to assume a 30-year mortgage. Let's say you've never owned a house before. I selected a 5% interest rate. I probably should have gone higher than that because interest rates aren't expected to drop anymore. They're actually forecasted to potentially go up in a couple years. But this example also doesn't factor in any kind of mortgage renewals. So that's just something to keep in mind. And like I said, estimate only. So your monthly mortgage payment with all of this considered ends up being about $2,972.04 a month. I just use the calculator.net here. You can go to realtor.ca to get your monthly payment side of it and just do the math from there if you want to play around with the interest formulas. I didn't for this. Now, something you could look at now is how do I compare this over the long term with renting? So overall, in 10 years down the road, if you're paying a mortgage, it ends up being about $392,309.28. And you do still, because we're only 10 years in, this is a 30-year mortgage, you have a balance remaining on that mortgage of $450,340. That's just, again, calculated using that calculator.net calculator. And you see this and it's like, is this really smart to actually buy? Like, I'm paying the same amount to rent and this doesn't even factor in taxes, maintenance, insurance, stuff like that. So hold it for a second, because here's where people get a little tripped up. It's not just about what you're paying every month, it's what you're gaining. Because you have to remember, when you're buying a house, you are buying an asset. And assets can depreciate, but they can also appreciate over time. And over the long term, real estate appreciated. And that's where this comes in again. So I use this trend line to sort of just get a very rough estimate of 2036. Again, this is not intended to be a binding prediction for the future. Don't hold me to this. This is just for the sake of a theoretical example. Now, for January 2036, what you'll see, I sort of just did a little intersection, but I did also add a little bit of a buffer zone in these areas here, because let's face it, it's not always that close to the trend line. There are dips and there are places where it's been higher. So I did want to add about $100,000 of a buffer zone, and I even picked the worst case scenario from this. I assumed it would be $800,000. So you bought it in 2026 for $587,000. It's now worth $800,000. Basically your asset, your home, has increased by $212,625. Now, that's not even the whole point of this, because you have to put the pieces together. So equity really is all about what your home is worth, taking away all your debt, what's left over that you can actually use for something like maybe a line of credit or whatever down the road. And if you have a mortgage balance left of $450,000, you take that off of your $800,000 house because it's now worth that, you've got equity. You've got $349,660 that you can use. Now, obviously, there's different ways of using this. Like I said, line of credit, loans, what have you. And this is how real estate really works. You hold it long term. I always tell people, like, you got to buy a house for, I mean, ideally 10 years or more, but at least 5 years, I would say. Don't get into fast flipping. It's just not worth it right now. A lot of people will say, like, hey, I don't want to pay interest though. Why would I pay a mortgage? The interest will drown me. Well, as you can see, you've paid about $253,000 in interest, but you've gained $349,000. And that's factoring in the interest remaining to pay off the mortgage as well. If you put that and you compare this to your rent payments, that's a negative number. You're losing $396,000 rather than gaining that $349,000. So this is why I say, like, if you got to figure out a plan. If you want to save for your future, because let's face it, saving on top of a rent payment is hard. If you're doing a mortgage payment, yeah, you might not be able to save extra on top of that either, but you're getting those long-term returns still, and that's where the benefit of real estate is.